My name is John Ross with Finance on a Budget. Are you a complete stock market newbie? Do ETFs and market indexes sound like some form of alien language to you? In this video, I'm going to make it simple as humanly possible. I'm still figuring it all out, so if I didn't understand it, I rewrote it so that both you and I could understand it. This video focuses on exchange-traded funds, or ETFs, and the best strategies for beginners so that you can make the most of your investments. We'll go over the pros and cons of ETFs. Please like this video, subscribe, and ring that bell notification. What is the Stock Exchange Traded Fund, ETF? A stock ETF, or exchange-traded fund, is designed to track certain industries. For example, an ETF can include technology, real estate, or blue chip, old companies. You may buy a single ETF stock, but the people behind the stock are investing in other stocks. Let's use an example of the stock name Vanguard S&P 500 ETF, with the letter code of VOO. If you buy one share of the VOO stock, you are actually investing in a tiny share of 500 different companies. These are based on the S&P 500 Market Index, a guide, which tracks the largest companies on the stock market. These ETFs generally follow one type of industry. A technology ETF may buy into Apple, Microsoft, and Tesla. A blue chip ETF may include McDonald's, Facebook, or Johnson & Johnson. If you were to buy one technology ETF, you would own a tiny percentage of the stock of Apple. If you buy one blue chip ETF, you may own a tiny share of McDonald's. But unlike individual stocks, you are not relying on a single stock to perform every day. The strongest companies of the day will help the weaker ones so that the stock prices generally stay fairly consistent. An REI ETF, a real estate fund, is a great investment. This is built on large publicly traded companies that buy, sell, and rent real estate. Another great investment is dividend funds. Dividends are when they pay you extra just for owning the stock. Once again, another video, links below. Just like other stocks, the prices can adjust throughout the day. With ETFs, you can take advantage of immediate diversification that's easy to trade and low cost. It's a great passive investment vehicle that can yield a pretty good return without you having to be actively managing it. Not only has VOO come back after the pandemic crash in March 2020, it has also exceeded where it was before. This is why ETFs are safe. You are not investing in just one company. The strongest of the companies keep propping up the weaker ones. So why are ETFs so popular? Well, they're flexible, low cost, and tax efficient. Over a long period of time, they can even have the potential to outperform actively managed funds. Here are several different types of ETFs that are available to you. Bond ETFs. With a bond ETF, you can get valuable exposure to different types of available bonds out there, which include high-yield, U.S. Treasury, international, corporate, and municipal bonds. Sector and industry ETFs. If you are only looking for exposure to a certain industry in particular, sector and industry ETFs are the way to go. This provides exposure to industries like high technology, pharmaceuticals, and oil. Market ETFs. These are designed to track a particular index with the likes of S&P 500 or the NASDAQ. There are actually quite a few more, but I trimmed this list down to some of the more obvious ones. What are the pros and cons of ETFs and how do they work? Similar to stock, you can buy and sell an ETF when the stock exchanges are open. You can base your investment decisions on the ticker symbol and the price data throughout the trading day. Keep in mind that ETFs, by nature, are incredibly easy to trade, mainly because you can buy and sell pretty much whenever you want, any time of the day. Because these are index-based, you can rely on a whole lot of transparency since they're required to publish those holdings every day. They're also very tax efficient because they generate a lower level of capital gain distributions. What are the best ETF strategies for beginners? As a beginner investor, you can always go with the dollar cost averaging, or DCA. DCA means that you buy an asset at a certain fixed dollar amount on a regular schedule. This means buying regardless of what the asset's charging cost is. For example, buying $100 worth each and every month, regardless of the actual cost of that day. The goal is that the stock will always be going up. You can also use ETFs to get exposed to any market in the world, regardless of the industry sector. It's an extremely flexible way for you to weave in and out of markets, add alternative assets to commodities or even gold, and adjust your allocations based on the changes in the overall risk tolerance and investment goals that you may have. Another type of investing is called swing trading. This is what I personally use. Swing trading is a style of trading that attempts to capture short to medium term gains in a stock over a period of a few days to a few weeks. Basically, you can calculate the true value of a stock by going back a few weeks and drawing diagonal lines across the high values and the low values of the stock. What's right in the middle is going to be the true value. Because ETFs by nature have a wide bid-ask spread and have plenty of room for diversification, they can be really efficient for swing trading. Buy when the stock goes below the estimated threshold and sell when you're comfortable. When should you invest in ETFs and why you should? ETFs come in handy when you have a large chunk of money laying around, say from a stimulus check or money rolled over from an old 401k to an IRA. With an ETF, you can invest smaller, low-risk amounts and still be able to diversify and assemble a pretty decent portfolio. Make sure you buy ETFs from a trusted broker or brokerage account like Webull, Robinhood, or M1 Finance. Links below. Consider what the index tracks, how the ETF is constructed, and how long they've been around for its historical performance. Remember that your investments will always have tax consequences. Unfortunately, while ETFs can be relatively tax efficient, as they are due to their nature, some ETFs that have less static indexes and trade more frequently may lead to more capital gains costs, which is why it's crucial for you to look at the big picture when you're picking out the best fund to invest in. It's not going to be enough to check the fund's historical performance. Just because it's done well in the past doesn't mean it's guaranteed to do just as well in the future. How then should you choose the right one that's best for you? Pick the fund that will go perfectly in sync with your trading goals, time horizon, risk appetite, and your budget. ETFs versus stocks. Which one should you choose? First, you have to figure out what your investing objectives really are. No two traders are exactly the same. Most will have specific exposure requirements about the trade, whether it's related to a specific stock type or sectors such as construction or financial services. Second, you have to consider your own risk appetite. Are you a high-risk, high-return kind of person, or do you prefer to keep it nice and safe when it comes to your hard-earned money? Are you the type to go all or nothing on your investments? I mean, does it even make sense for you to take on so much risk if your own financial status doesn't look so good? Beginners should never overexpose themselves to unnecessary risks. Third, figure out what your investment timescale is. The length of the investment will help you figure out whether you're more inclined to take stocks or more suited for ETFs instead. And finally, always make sure to stay within your financial means and know how much your budget is. As a beginner, investing may seem overwhelming at first, which is why you need a low-cost alternative to stocks, at least until you get the hang of things. ETFs offer that kind of flexibility and safety, which is extremely valuable for someone who's financially unstable. Before you even dismiss all of this as something you don't even want to do, remember that investing is one of the most efficient ways that you can get that sweet, sweet financial freedom. Don't be afraid of investing just because everything looks so complicated. Like any other skill, you just need to practice a bit first. Be sure to give this video a like, subscribe, and ring that notification bell. Thanks for watching.